Hello again everyone, welcome to the 16th of our CIMA P3 Performance Strategy lecture recaps. This one was on financial risk. The first area we looked at was the management of financial risk. We looked at the stages that we go through, first of all to identify the risk exposure, then to quantify that exposure, to decide whether or not we're going to hedge the risk, and if we do hedge it, to implement and monitor the hedge. Okay, so that's basically what you would do in an exam question as well. So to quantify the risk, well, we can use regression analysis, simulation analysis, expected values, or even value at risk. All of these will quantify the risk that there is. Hedging then, well, what are the advantages and disadvantages of conducting a hedge? Well, on the plus side, you'll have certainty of cash flows. You'll know what you're going to get. You'll reduce or indeed eliminate the risk. You may reduce tax depending on the type of hedge you use, and you will attract risk-averse managers to your organisation because they will know that you hedge your risk. On the downside, the shareholders are assumed to be already diversified, so by hedging you're effectively diversifying them again. There will be transaction costs involved. You may have a lack of expertise in the organisation to actually conduct the hedge, and they are complex, which can prove difficult. Derivatives then. Derivatives are an asset whose value depends upon the price of another asset. Okay, for example, gold. You could get a derivative of gold, a future on gold. So, different types of financial risk. Credit risk, first of all. Well, credit risk is the risk of not getting paid or getting paid late. We can control credit risk. How do we do that? Well, we can have credit checks, we can have credit limits, or we can implement debt collection. We may also be able to insure our credit risk or use a debt factor. So those are all ways to hedge credit risk. Political risk. Well, types of political risk. There may be restricted local borrowing if you're in a different area. You may not be able to repatriate the funds that you receive. There may be currency restrictions on how much currency you can actually change, and there may be volatility in the currency rates if it's maybe a small emerging country that you're dealing with. There may also be quotas or tariffs involved, which mean that it makes you a little bit less competitive. Managing these types of risk, well, you could go into a joint venture with a local business or with the local government. Again, agreement with the local government. You could attract local financing from local banks, which gives them an incentive not to impose any of these risks upon you because it's in their interest to get their money back. Or you could give share incentives to local managers, i.e. after 5 years, given certain presumptions, they will get a share in the business. So, some more types of risk, some of the main ones that we're going to look at. An introduction to interest rate risk. Remember, a variable rate will be quoted as a percentage above the base or above LIBOR in the exam. And the risk of a variable rate is that there's an increase in the rate. You're exposed to that variable rate, so if there's an increase in the interest rate, you will have to pay it. A fixed rate, well, the risk of that is that there's a decrease in the interest rate. Because your rate is fixed, you have an opportunity cost then, because you have a fixed rate, the interest rate has gone down and you don't get the benefit of that decrease in the interest rate. When it comes to refinancing, well, there's a risk of not being refinanced, either because conditions have changed or perhaps because your credit rating has dropped. So therefore you may have to take higher rates than you had before. And a lot of businesses have found this with the recent volatility in the markets. They were on preferential rates, they've now come out, there's much higher rates because banks don't want to lend. Currency risk, we're going to look in much more detail at currency risk, but the types of currency risk, there are three types. Translation risk, this is really related to subsidiaries and assets which are in a foreign currency. They may fluctuate in value simply because the foreign exchange rate moves up and down. So by the time that you come to put them into your balance sheet, they've maybe changed in value and aren't worth what they were previously. How do you manage this? Well, you can match assets and liabilities. You can match your foreign assets and your foreign liabilities, and that's matching. Transaction risk. Well, this is basically where there's a currency movement between agreeing the transaction and the date of payment, i.e. you agree a rate or a payment, you then wait for 3 months because you've got 3 months credit, and when you come to pay that bill, the currency has changed and it costs you more. Okay, so that's transaction risk. Economic risk is really long-term transaction risk. It's that you have operations in a different currency or a different locality, and the long-term effects of the exchange rate are that you make less profit or less money than you were expecting. That's economic or long-term transaction risk. How do you manage that? Well, you basically diversify. So you can diversify your production and supply or your financing to try and manage your long-term transaction risk. So that was our introduction to financial risk.